This has been, in 7 years at the Chamber, this issue has probably been the most, most I've heard about an issue, policy change that the federal or provincial government has done or is proposing. And so it is really problematic for the small business community. I think one of the things that I kept hearing about in putting this event today is as partners from each of the accounting firms, and when I would be at events saying, this is really problematic for my clients. Greg Weiler is a partner at BDO Canada, right here. Greg specializes in advising clients how to minimize and defer payments of their income taxes and provides proactive tax planning advice on business sales, purchases, reorganizations, and succession, as well as trusts and estate planning packages. Greg has a diverse client base and owner-managed business, everything from real estate, manufacturing, financial services, and professionals. He also is a past chair of the Greater Kitchener-Waterloo Chamber of Commerce.
In terms of the proposals that were made on July 18th, they really affect sort of three buckets of changes. The first one is income splitting. The second is the taxation of investment income, passive investment income in private corporations. And the third one is capital gain strips. So in the first bucket, in terms of the income splitting, it also includes some significant changes in terms of capital gains and the taxation of those gains, including the capital gains exemption. The taxation of passive investment income in private corporations has some wide-ranging effects, to say the least. Probably the most significant change is proposed since 1972. And the last one, the capital gains strips, is a bit of a technical argument that deals with the interplay between the top personal rate and the capital gains rates. So we can get into a bit more detail with the other guys in their comments on those three different buckets, but some general concerns that we've sort of identified with these three buckets of proposed changes and the whole process deals with, initially, this is supposedly a consultative process, but they came out with draft legislation in two of the areas, like, what the hang? So we got a short consultative period, 75 days, starting on July 18th, ending on October 2nd, where most of the people are away at the cottage and don't even want to think about this stuff. All the rules, these proposed changes, really do not take into consideration the risks that our small business owners are subjected to. And they really don't take into consideration the fact that most small businesses are family enterprises where all the people in the family are involved in some degree at one point in time. Our federal government should be supporting small business and creating innovation and giving them a leg up to survive. Most small businesses, 80% don't survive the first 5 years, so we should be doing more to make sure that they're successful.
Next, Mark Walter is a corporate tax planner with PwC and auto industry specialist for Southwestern Ontario. He's got over 20 years experience in providing tax services to a variety of multinational companies on issues including mergers and acquisition, cross-border expansion, refinancing, transfer pricing, and shred tax credits. He works with clients in a variety of industries, including manufacturing, engineering, construction, transportation, and technology. So, Mark, the floor is yours.
Great. Thank you very much, Ian. I'm just going to drill down a little bit deeper on one of the pillars that Greg alluded to, and that's the capital gains stripping. And the reason I want to focus on that for a few minutes is that is the part of the legislation that was effective immediately at the announcement date with some retroactive implications. It's really important to understand that concept of integration. Greg touched on it, and I think there's an assumption in the room that everybody knows what that is. Very briefly, that's the integration of the corporate and personal tax systems, so that if you earn $1 as an individual, you pay the same rate if you earn it through a corporation and distribute it out to yourself. We think integration works very well till now and has the potential to come undone here with some of their proposals. But to talk about the capital gain stripping, you have to think about the tax rates that are applicable here. When you look at a capital gains tax rate, we usually assume 1/2 of the normal rate. So if we talk about a 50% rate in Ontario, and it's actually 53, you're looking at about a 25% capital gains rate. Dividend rates, it varies between eligible and ineligible. It's going to be between 40 and 45%. why wouldn't you structure your affairs to achieve the capital gains rate? It's just normal business planning in today's environment. Perhaps they could have increased the capital gains inclusion rate to 75%. There was a lot of noise in the press about doing that. I suspect they backed off on that proposal because they thought it affected the middle class. What they did instead has a huge impact on the middle class, as you'll see here today during our conversation.
David Van Vorst is an associate partner with Ernst & Young. He has been a partner in the Toronto office and been with E&Y since 1989, been practicing for over 20 years. His expertise in providing income tax advice to Canadian and multinational companies, and works exclusively providing tax structuring, tax due diligence, research, execution, implementation of tax planning strategies related to, again, mergers, acquisitions, and reorganization of businesses. His focus of his practice is mainly on assisting families and private companies selling their business. So Dave, maybe the floor is yours.
Thanks, Ian. So the government released these proposals, the most significant for private corporations since tax reform in 1972, at the beginning of the summer when people are trying to relax and take time with their family. And there's a 75-day consultation period that has been mentioned that ends October the 2nd. And it's interesting that for much of that period, it was covered by the summer and a period of time when Parliament wasn't even sitting debating these new rules. So I just throw that out as a kind of a observation. And it's apparent that the government doesn't understand or care about some of the tax consequences that these rules are going to result in the pursuit of fairness. So things like designing a system that favors the sale of the family business to arm's length parties, including non-residents rather than family members, subjecting assets to double and triple taxation when they're held by a corporation on a shareholder's death, subjecting passive income earned in a corporation to 73% effective tax rate when it's distributed to individual shareholders.
So our last is Carlo, and I'm going to say, can you help me with your name, Carlo?
Charmitaro.
Like I said, Charmitaro, he's a chartered accountant with KPMG. He's got 20 years' experience in research and development tax. He leads KPMG's Canadian and America's regional research and development tax incentive practice. He works with industry, policy, and tax regulators on R&D incentive programs, and is a part of KPMG's Global R&D Steering Committee, representing Canada, U.S., Mexico, and South America. He regularly liaises with partners in both the U.S., the U.K., and Australia. And so, Carlo, the floor is yours, and maybe tie together our previous discussion from last week, and then I've got some questions to drill down at what Dave and Greg and Mark and you have been talking about.
Sure. Thanks, Ian. And so we'll take a little bit of a different approach. We've heard from our colleagues here that the changes that have been proposed by the government are quite radical and quite substantial and really are disrupting what's been normal planning probably for the last 50 years. Last week, the Chamber hosted a session with the three local MPs and invited a number of different stakeholders to provide their thoughts and views and opinions on what these rules mean to them and how these rules would impact them, and in many cases adversely impact them. And it was quite an interesting discussion, and in sort of coupling or grouping some of the discussions into themes. The biggest theme, or one of the largest themes that we heard, were from the local small, medium-sized businesses, whether you're in tech, whether you're in manufacturing, food and agriculture. The part that's the most disturbing of all the rules that are being proposed are these passive investment rules. In particular, the proposed manner in which the excess funds are going to be taxed, and it's all around the concept of the tax deferral. And so, at issue is the government in their documents that were circulated for commentary, suggesting that individuals are unfairly incorporating their businesses in order to take advantage of this tax advantage, this tax deferral opportunity, which enables them to have access to more investment funds, which they can then invest passively compared to an individual that would otherwise have paid tax at a much higher rate. But one of the, a concern that was raised by many of the businesses is that in many cases, the tax deferral and the ability to pool up this cash is extremely important for them. Many of the startups that are receiving funds from, let's say, venture capitalists or funds that are helping them try to grow their business, or individuals that are running operations that are very heavy capital-intensive businesses, they need to stockpile their cash for periods of time because they don't know when their next capital investment is going to be made. In some cases, the lead times for projects may take a number of years, so you need the cash available so that you can invest that cash in your business, and then eventually, hopefully, you can materialize that and sell that down the road, and the cycle sort of begins again. And so the concern is that if this capital now is taxed at a significantly higher rate of tax than currently exists, the issue is where are they going to get the money? As many businesses in the room know, it's very difficult to get funding from banks in good times, let alone tough times. So the issue here is that their financing is going to be impacted. In many cases, quite frankly, businesses have to put up a substantial amount of cash as collateral to support a letter of credit or what have you, to support the bank funding that is required and necessary for the business. So, having this rainy day fund is extremely important, and these proposed rules seem to suggest that may change the way these excess funds can be pulled together. The other aspect of it is that some of these funds are being retained for the owner manager, their family, that are actively involved in the business, and in many cases, they work hard for a number of years in order to pool up these funds, and these funds really form a part of their pension. You could almost view these corporations as another form of RRSP, that they can sort of draw down the funds at a later point in time when they retire. And so the issue now is it was kind of interesting. The other day there was a report that the federal government issued where they contemplate, or they expressed a concern that many Canadians are not saving enough for their retirements. And so here's a group of small, medium-sized entrepreneurs that in fact are trying to do that, and especially the ones that are sort of at the tail end of their careers, and the governments are now proposing to pretty much strip those funds away with their proposals. I guess the fundamental issue, and one of the my colleagues here touched on the impact that these proposals are going to have on intergenerational transfers. In many cases, there's a lot of local businesses, successful businesses that are second, third, fourth generation families, and these families have been able to pass their businesses on to the next generation in a very seamless and tax-effective manner. These new proposals really disrupt that and it effectively increases the tax rate upon this transfer considerably. And I guess what's disturbing most entrepreneurs from what we're hearing about these new proposals is that many of their structures, whether it's their tax planning, their estate planning that's been put in place, have been based on fundamental principles that have been enacted in the Income Tax Act for the last 50 years. And it just seems that all the planning and everything that's been done in the last 50 years in accordance with the rules is now being taken away from them. And that's the part that was really vocal in the discussions that we had last week.
Is income sprinkling a real big issue? Because it doesn't seem from the comments that I've heard. The CRA already has a pretty good handle on that.
Yeah, it is a bit of a red herring, in that there are attribution rules out there, all sorts of rules that prevent a lot of it from happening. They're concerned about basically dividend income splitting, with principally that 18 to 24 age category, the students that are going to school. You could pay basically $40K per kid per year in terms of the dividend sprinkling, and they would pay very little income taxes, whereas the parents would pay considerably more. Again, it's a narrow window in terms of what people can do with it, but it is affecting many other small businesses, and it affects the amount that they can reinvest back into the business. You know, usually the whole family is involved in the business. If you can sprinkle some of your remuneration in the form of dividends amongst the family members, you have more money to put back in the business, and that money is needed for the business to grow and survive. So,
Isn't that another way of, and yes, there's RESPs for those that are an employee, but that effectively is you're saving for your kid if they're 18 to 24 and you're sending them to university, and we all know how expensive that is. You can take some of that money, give it directly to the young person so they can pay for their own education for the work that they've performed as part of the business. I mean, that's the sort of rationale that I think people use it for, and they're wrapping that all together with tax cheats or some of that language that they've used, which I mean, I think is that the other reason that small businesses are so upset is they're being accused of cheating with rules that are in place today.
and that's what really grates me and a lot of our clients. Like, they have used their businesses and their holding companies associated with their businesses as their primary retirement vehicles. And we've told them to do it, and it's a great way to do it. It's effective. They don't have the ability to participate in a defined benefit plan. So this is their defined benefit plan, except they are taking responsibility for it entirely, so.
Let's go to the capital gains issue, because I think this is where it gets tied up, and to simplify it a little bit. What really is the issue here? I mean, we've talked about passing, and I think this is the one where we heard many comments. There was some comments around family farms, and as you pass your business from generation to generation. I mean, two of the business owners that were at our session said it makes no sense for them to do it internally to their child, that they should actually sell it to a third-party person in the United States to get the most advantage of their business. So to transfer your business inside to a family member, it makes no sense. How did this proposal come to be in terms of the capital gains and the transfer of businesses between generations? Maybe we'll start, Mark?
Yeah, I mean, that certainly is an interesting one. And, you know, they talked a bit about it in previous federal budgets, but the way they introduced it was a bit of a surprise. You know, we were often arranging the affairs of a company. If we saw an asset with an accrued gain, you know, why not trigger that gain and realize the capital gain and then get the capital dividend account distribution? But we took it further. We used it on sale planning. We were able to reorganize a company prior to sale to trigger gains on assets and get the CDA out and some of the refundable tax. I think they saw that planning. They attend the same tax conferences we do. They can see what kind of planning is going on. But to your point about succession planning and passing the business down, if at the end of the day the rules recharacterize these gains as dividends and the business owner is subject to that 40 or 45% rate, wouldn't they rather sell to a third party and realize a gain at a 25% rate? And that's the point that we're trying to make to government, is that you've made it very difficult for succession planning and passing the business down if we're going to recharacterize these gains as dividends.
Dropping the consultation on July 18th raised a lot of alarm bells. For those of us that have worked in government, if you're doing it in July, you don't want people to notice, which is precisely why they did it. The fact that, and I can't remember who said it, but maybe you can touch on this. The fact that the word reasonable or reasonableness is used, I think it was 67 times or 76 anyways. It was a lot of times in the legislation, is downright scary from a business perspective, because there's no certainty in what they're actually proposing in the legislation. Maybe talk a little bit about that, because that's the uncertainty that's being created by this.
And that's, again, it's another area where it's caused a lot of discomfort amongst many taxpayers. The new rules have really muddied the waters. They've really have introduced a lot of subjectivity. So here's the government talking about fairness and clarity and making things a lot more transparent, and now they introduce these new complex rules that say, well, you know, before we pay out a dividend to any of our family members who happen to be shareholders, you know, it's almost a 5-part test that you have to go through and assess whether or not the dividends are reasonable, and if they are not reasonable, you put them through some additional tests, and so it creates a lot of uncertainty and subjectivity, which, you know, if anyone in the room has had the pleasure of going through a CRA audit, you know, audits and compliance compliance time and audits have increased tremendously. And so here's an area where the waters are so gray, like it's so murky that, you know, you're basically going to have to justify the reasonableness of a dividend, and your guess of what's reasonable or what you think is reasonable may not be in line with the CRA, and you're going to have to spend time as a business owner now. Not only are you trying to run your business and keep the doors open, you're going to have to figure out what's reasonable. I'm going to have to document every individual's activities. I need to go through my memory and remember what mom and dad did 10 years ago because they were actively involved in the business. Now they're not actively involved, or they've sort of gone into their retirement. What sort of activities they're doing in order to justify that dividend that's being distributed to that particular individual, and whether or not it's reasonable is going to be a subject of debate. So it's really it's really introduced a lot of uncertainty, which is unfortunate. I think that's the part, if anything, that needs to be revisited by the government through the consultation process, is really looking at those sets of rules. Because as you said, 67 times, I think it was mentioned in their consultation paper, so
Yeah.
that's unreasonable.
Oh, all right, yeah, it is unreasonable. Okay, let's go to passive investments, because I want to drill down with a few more examples, maybe each of you, without getting too technical, but the types of businesses that you work with and some of the challenges they may face. Small business do set up these corporations to leave cash in their business for a variety of reasons, and as has been pointing out, whether it's 40 or 50 years, it's been in place as a vehicle for business to do that. So, but businesses do use it for purchasing of new businesses or acquisitions, capital investment in their existing business, as you've mentioned, but things like, depending on what type of corporation you are, maybe it's maternity leave when you have no income, if you're not eligible for those benefits. A rainy day fund, the example I used for one of the Liberal MPs, is if you're a business owner on Victoria Street where the bridge just went down and is going to be out of commission for 2 years, you're probably going to see your business income drop 30, 40, 50% for a couple of years. I would assume that many businesses that do keep capital in their business, whether they plan for retirement, but they also use it for that rainy day fund when they maybe lose a client or they have downtimes in their business. And then we did talk about it as ultimately a retirement vehicle, but it gets used for all of those types of purposes. Maybe, I don't think it's fair and reasonable. We can maybe all agree that that's probably not fair to make that change. Maybe if each of you can give an example of a business or someone that you work with where they're going to face a challenge either staying open or being able to continue to succeed. Because I don't think the message is getting out that, this passive investment, it sounds like, the 1% flying on their jets to the Cayman Islands. We're talking about small business that use this for very real purposes. Maybe Greg?
I think it affects most of our small business clients who are saving for their retirement. With these higher levels of personal taxation on when the dividends are distributed, it's going to increase their tax costs, which means less in their pockets, which means they're going to have to save more. So, and potentially that's going to mean a hardship to them. So they're going to have to grow their business more dramatically or cut back on the size of their business. So it's just putting strain on the business owners. And that runs the full gamut, for many of our clients, because not all of our clients are very, very successful. A lot of businesses, they make a decent living. They're not, multimillionaires, but they do okay. But this is going to have a significant impact on what's going to be available at the retirement. So.
Okay. Mark?
And Ian, I want to add a point that's really important here, and that is the investment income that they're earning is already subject to a 50% tax rate inside the corporation, and that's really important. What they're really focused on is those earnings where they paid the 15% small business rate or the 25% general corporate rate, right? That's what they're looking at. And yeah, I do have clients that are accumulating the rainy day fund or, saving for investment in new equipment, new technology, and they can't get the bank financing that they need. It's not just about retirement, but that can be a good reason. But a lot of them is just sustaining their business. And so to put those kind of rules on them. And what bothers me the most about this is it won't apply to non-resident owned corporations. So look at the disadvantage we're putting Canadian corporations at vis-a-vis our non-resident owned, foreign owned corporations. That's unacceptable.
I had missed that. That is very troubling. David?
So the tax really catches up to you when you go and distribute the passive earnings as a dividend, and it's already been subject, as they said, to a high rate of tax, and right now, a portion of the tax is refunded, and under the new system, it won't be refunded. You could have a situation where the business might be in hard times, can't afford to pay the person a salary because it would trigger losses that perhaps they can't use. So the rainy day fund is being paid out as a dividend, and if you look at the total amount of tax being paid on the distribution, it'll approach, well, 73% in my example.
Carlo?
They need to pool up or save their cash in order to fund that, because their ability to get that financing through a bank or other investors is very difficult. And so, they need to bring these projects to a certain state before they can bring in investors and external financing and so on, and then they sell off the project eventually when the project is up and running. And so these projects span from anywhere from 1 to 4 years, 5 years sometimes, depending on the nature and the size of the project, and then you begin that cycle again. So, these passive income rules, again, will introduce a lot of uncertainty, because if that additional income is taxed at a much higher rate, there's less dollars available to do these sorts of
All right, we're just about out of time, but I want to ask two quick questions, so if we can quickly go up and down. And I guess this has been, each of you in one way or another has really talked about the element of risk that business owners, in particular, that are going to be affected by this, are putting in. The balance between being an employee and the certainty of your salary and your benefits and those things versus a business owner and an entrepreneur, I really don't think is reflected in what these changes or these proposals are contemplating. What would be, I mean, in your own, I guess this is more of a personal opinion, how do you quantify the risk element, and what is that, maybe the spread between what a corporate entity pays in taxes to achieve fairness versus the certainty of an employee having a salary? And I don't know if you've got an answer for that, but I'm interested, because I think that ultimately that's what this exercise has been about with the federal government, is to achieve fairness between an employee and a corporate entity. But it really doesn't factor in that risk premium. So maybe, Greg, you want us to take a crack at that?
Ooh, that's a bit of a philosophical or a theological question in terms of measuring an intangible. Good question in terms of, that risk versus the certainty of being a federal public servant. I think we need to encourage as many entrepreneurs as possible, and we need to give them as many breaks as possible, because they drive our economy. So a lower corporate tax rate and incentives to save within the business, to grow your business, I think is the best thing for Canada, for its future generations. So,
See, you had a great answer for that tough question. That's a great answer. Mark?
I agree, it's not really quantifiable, and you can't correct it by trying to amend the tax legislation to create a harmony that shouldn't exist. What I would encourage business owners to do, though, is to really look at their total tax bill. And if you've got multiple employees and you're contributing to CPP, EI, employer health tax, I'm sure you're paying your fair share somewhere within the system. And it may not all come out in the corporate tax, but you will pay your fair share.
Well, maybe that's for those that are going to write submissions to the federal finance department, is to maybe that's a good exercise to go through, is all of the other things that you're paying. David or Carlo?
I think that the whole risk aspect is difficult to compare across the board. It's dependent upon the life cycle of the business. But the riskiest businesses are those ones that are about to start up, and people are going to take risks. And if they design a tax system that would prevent people from wanting to take on those risks in Canada, then they may go elsewhere to do it.
Carlo?
Yeah, just, typical investment philosophy is if you take a risk, you're going to be rewarded with a higher rate of return. And so I don't think you're really comparing apples to apples when you're comparing an entrepreneur who's trying to drive and grow his business to an individual that's earning a salary. And so I think the two fundamental concepts are not aligned. I mean, at the end of the day, the individuals are still going to pay the same amount of tax. The issue is when that tax is going to be paid. And so, you know, the part of this is, you know, the government participating in part of the risk. You know, if you take a look at what businesses faced over the last few years, you know, increased personal tax rates, you know, increased corporate tax rates on the table, increased EI rates and CPP rates, increase to the minimum wage. You know, at some point, you're going to discourage business to take on risk. Who would want to take on that risk? It might be better to go work for the federal government. You know, at least you get a nice pension at the end of the day, and live, you know, life happily ever after. So I don't think, I think that's really at the crux and the heart of the debate, and I think the governments need to really look at that a little bit.
Okay, last question, and I guess this will be, again, for those of us that'll be writing submissions to the federal government, and I encourage your clients or the small business in the room to do that. I think certainly the Liberal caucus, you will benefit from hearing personal stories about how these changes will impact them. So, and I think at the end of the meeting, Carlo, one of the things that there were some suggestions that some of you and your colleagues made is saying, if what you're trying to do is get tax fairness, here might be a better way of doing it than what's being proposed right now. So maybe I want you to start with that is, you know, if in a perfect world, if this was withdrawn and saying, look, we're not going to implement this, we've heard there's concerns, but recognizing that the government does want to get to, you know, that tax fairness, what would be some of the things that might be a better way to achieve what the government what their goal is?
Sure, and I think at the crux of this is government's looking at the differential between the small business corporate rate of 15% to the tax rate that would otherwise be paid on dividends taken personally, which range anywhere from 40 to 45%, and that's at the highest marginal rate. So there is quite a big spread in that particular instance. And so one of the notions was, you know, these rules seem to put into disarray the concept of integration, which we talked about earlier. Well, maybe to get some fairness and maybe to sort of alleviate some of the government's concern with the tax deferral, an easy solution might be to just eliminate the small business rate, have all corporations pay the same general rate, and at least then you know the spread between personal and corporate tax rates would not be the same, or sorry, would not be as wide or drastic. But also you need to keep the concept of integration intact. Otherwise, that system falls apart, and then you could end up in a system where the corporate shareholder owner actually ends up paying more tax eventually when they do distribute those funds out personally if integration is not maintained. So that might be one solution.
Okay, David?
Certainly to alleviate much of the concern about income sprinkling, they should allow joint household tax returns to be filed, in which case the household pays a blended rate of tax instead of graduated rates.
Okay, Mark?
Yeah, I think, you know, I think they'll probably, and I'm hopeful, they back away from this whole passive income concept. There is no legislation around that. It's a trial balloon. I think it'll be easier for them to back away from it. So let's hope. On the income sprinkling, similar to David, they could remove the spousal part because that's getting a lot of negative publicity. And not only that, it's consistent with pension splitting that we're already allowing our pensioners to do. So there's some analogy there that you could draw. Perhaps they leave something in the way for the children, you know, that they feel there's an abuse of income splitting with children, so they might leave something around that ultimately. Yeah, those would be sort of how I see this sort of unfolding.
Okay, Greg?
Ditto, basically. narrow the rate gap, and really treat the family as one taxable entity, because that's how small businesses are run. You know, basically you've got the husband and the wife and the kids participating in the business. So, you know, give some relief for that. So I think that's a bit of a quantum leap for the government, but I think that's the reality of what's going on, and our tax system should reflect the reality of our business environment. So.
Okay, I appreciate that. That's all the time we have for today. I want to thank our panelists for taking time out of their busy schedules to speak with us today. I also want to thank all of you for taking time to participate in this important discussion. Thank you Also, to BDO Canada, EY, KPMG, and PwC are today's sponsors, and we appreciate their ongoing support of the Chamber.